Hey everybody, it's me, Gregory Mannarino. How are you today? It is Wednesday, March 28th, 2018. I want to run something by you, and I would love to hear your opinion about this. So, it's no secret that this market, the volatility has been crazy as of late. This morning, the market's been open now for just about 40 minutes. The market has been up, the market has been down. As I am doing this video blog, it is back up again. So the market appears to be trying to find direction or guidance. Now I think this is more guidance. Now what am I talking about? And this is where you come in. We all understand, and I covered this yesterday, there's something going on here in the bond market that I don't believe the Federal Reserve has a handle on at all. Again, the Federal Reserve is raising rates. Yet, despite that, yields are dropping on their own. A massive amount of cash is making its way into the bond market. I think this is clear evidence that the Fed is losing control. Now, this is what I've been pondering, and again, think about it. So, the spread between the short end of the curve and the long end of the curve with regard to yields continues to shrink. What is that doing? Flattening out that yield curve. It's nearly flat now. It's nearly flat. So, being that the stock market gets, and everything, as a matter of fact, derives its value from what's occurring in the bond market, I think the action we're seeing here in the stock market lately is because of this flattening yield curve. Here's the interesting, or I suppose ominous part of this entire thing. We've seen this before. If you were to go to look at a chart of the dynamic yield curve, just Google dynamic yield curve. You'll be able to see for yourself that the action that we're seeing in the bond market and the stock market is mirroring what happened at the top of the dot-com bubble and at the top of the last bubble in 2008. It's happening again right before our eyes. It's the same thing. History is repeating itself. So that's what I think is driving this market. I mean, like I've always explained to you, every asset in a real market derives its value from what is happening in the debt market. The debt market is the largest market of them all. So if we now have a yield curve that continues to flatten out, that is the spread in the yields between the short end of the curve and the long end of the curve is shrinking, flattening out that curve, the market is going to have to adjust for that, the stock market, despite the fakery that is going on. And they're propping up that bond market right now, or part of a safety play as well. It's a combination of things that are going on here. But what I really want you to think about is how this market seems to be repricing itself, I think, based on that yield curve flattening out. And again, we've seen this before 2 times in recent history, and it's happening again right now. So we, beyond any shadow of a doubt, have got to keep our eye on this situation moving forward. All right, with that said, we will reconvene later. I would love to hear what you think about this. I don't even think it's a theory. I think it's a fact that the market is readjusting, stocks are readjusting to that flattening yield curve, which is going to invert. The Federal Reserve cannot normalize their balance sheet fast enough to prevent an inversion. And Morgan Stanley, once again, I want to say backed me up on that. They've been kind of interesting to me lately. And maybe this big precipitous drop that we've been seeing as of late with regard to cryptocurrencies is a warning as well. Because I have said that the cryptocurrency market, what's happening over there, is kind of like a risk-defining indicator. and it has worked for quite a long time, but there's a lot of stuff going on there too. You know, I covered this. But anyway, let me know what you think. Is the market, here's the question, is the stock market trying to reprice based off of the flattening yield curve? Is that what we're seeing? Do you think that's what we're seeing? Because I think that's what we're seeing here. And the next step was going to be a completely flat yield curve, an inversion, and a repeat performance of the last two market crashes. All right, with that said, I will read the comments, and I will see you later. Over and out.